Have you ever wondered what the J in Donald J. Trump stands for? It's deeply disappointing. I don't think I should disappoint you, because since November the 9th of this year, the day after Donald John, I told you it was disappointing, Trump was announced as the US president-elect, the big winners in markets have been bank shares, which have surged 13% over the past week. This is in the United States, as measured in the KBW Nasdaq Banks Index. But also, investors have been pouring the most amount of money into exchange-traded funds than they have in 9 years. This is the MoneyMakers. I'm Bruce Whitfield. Tonight I'm joined by the ETF Strategist at ETF South Africa, Nerina Visser. She's my guest. She joins me to talk about why investors see ETFs as a safer bet. All an ETF is an average of the value of all of the shares in an index. If all shares go up, it's good. They all go down.
Yes, but all shares is just some of the ETFs. Yes. So there are many different types
in
of
an index.
ETFs.
You can have a financial index, you can have a resources index, and all share index, or top 40 index. So in an index.
Exactly. So absolutely right. So it's the aggregate up and down. So it's also not if all the shares or most of the shares, but if the biggest shares go up and the biggest shares go down. So in our market, for example, we know that means, it's only a handful of shares that need to either go up or down to take the whole index with it. In the US market, somewhat different. So something like the S&P 500, which is certainly not quite all the shares, but it's a big proportion of the shares. The biggest weight there is less than 4%. So there it is more a case of all the shares in the index.
So the biggest weight in the United States in the S&P 500 is about 4%. Ours is closer to 20%, courtesy of a little business called Nasdaq, which owns
worth about 10 cents, I think.
A little business in China called Tencent, and it's only got a third of the business. But you've got, if Nasdaq, British American Tobacco, AB InBev, and First Rand fall 5% on a day, the market's going to be down by 4.5%.
Yes, indeed. Obviously, depending on what the rest of them do. But yes, in large part, you also find that these, call it basket trades, so the big stocks all moving together, often you find that they do actually pull one another down way beyond maybe what fundamentals would have implied. So you could have, you mentioned British American Tobacco, First Rand. One could argue, what on earth do those two companies have to do with one another? And yet you probably find that there's more correlation between their share prices than one would have expected if it was just a purely fundamental exercise.
Is that because of exchange traded funds? Because there are so many funds, there is so much averaging?
Not so much because of exchange traded funds, but rather because of indexed or basket trades. Now, those could include also your futures or your options trades. The reason why I say not necessarily ETFs is ETFs typically trade in the secondary market, which means that there's already an existing indexed unit that exists, and the market really just trades in that secondary market. It does not trade in the underlying shares to the same extent that needs to be done if you are trading options or futures and you actually hedge the entire underlying basket. So yes, it does affect it to some extent, but ETFs are not really the main driver of that increased correlation.
Now, Donald Trump, there seems to be a strong right of center consensus that Donald Trump is going to be a big spending, inflation driving president of the United States, president number 45. And that's all well and good if you don't have $20 trillion of debt, which America has, courtesy of its massive bond buyback program done by Ben Bernanke in order to try and refloat the global economy. Donald Trump is promising to spend billions, 650 billion, I think is the number he's mentioned, come hell or high water. Is it going to work?
It's an interesting question, and I think what the market is telling us at the moment is that there are more people that are starting to think that maybe this can actually work. And if you only were to look at it that this has to be funded from debt, so if there's a budget deficit that he now has to fund by debt, and you've got a reduction in taxes and therefore really a squeeze in terms of your budget deficit, then yes, maybe it won't work. But if you look at what he potentially could put on the table, which is to say, let's incentivize US corporates to repatriate all the money that are sitting in other markets around the world. Repatriate cash, and there's a lot of that, but also repatriate operations. And maybe part of the tax cut comes in the form of a tax incentive that says, company, if you do that and you do bring your business back to America, we'll give you a tax cut. And what he's betting on there is that the spin-off effects that will be felt within the economy, increased employment, increased secondary sort of tax effects, will offset whatever tax incentives he gave away. Now, if you do that, then yes, potentially it could work, because in the past we've always looked at S&P 500 companies and S&P 500 earnings and said a strong dollar is bad for the S&P 500 because of all that money sitting offshore. If you're now looking at this alternative type of model, then suddenly a strong dollar is actually not bad for S&P 500 earnings.
That's how it could work. What are the big potholes in this road to a miracle US recovery? Because surely if it was easy, Barack Obama would have done it in 2009.
Well, he's a Democrat and Trump is a Republican. So I think we've now had 8 years of Democratic policies, and they tend to be not necessarily so market friendly. They tend to be more socialist. They tend to be more for the good of all the people rather than just for the good of the few on Wall Street.
But if you wanted to create jobs through spending money, you can do that. If you wanted to get economic growth through spending money, you could do that. Now, that's neither Democratic nor Republican policy. It's just common sense. What held the Democrats back and what's pushing Trump forward?
I think the Democratic focus was a lot more on actually creating jobs and in lower income sectors, but also welfare spending, social spending. So Obamacare was very big. Also bear in mind that the Obama presidency ran across the 2008 financial crisis and had much bigger issues to deal with just than where we are today, 8 years down the line, and having to deal with maybe just the start of a strong economic growth phase for the US. So I don't think this is just that the Democratic policies were bad. They were probably appropriate for the time, but Trump is now coming into power at a very different time.
Good for ETFs?
Well, yes, for some ETFs. So again, it's not really about, the ETF is really just the delivery mechanism. It's the financial instrument that gives you, it's the bag. Is it a box or is it a plastic bag that you're buying whatever you're buying in? So we're going to come to why ETFs, I think, is a good delivery mechanism and why we saw a lot of money going into it. But more importantly is it's what's inside the box and what's inside your ETF. So you've spoken about which ETFs have already performed very well and the normal culprits or the expected culprits are there. But what we saw since last week, Wednesday, when news sort of broke that Trump was going to be the next president, was very much a focus on S&P 500 ETFs. So really buying just the broad market. Now, why then ETF? Why not just go and buy the shares, or why not invest in a mutual fund or a unit trust as we call them? The ETF has got two massive benefits over any other form of trading. It is an instant exposure to all 500 shares. So it's one trade and you get the whole basket. Whereas if you were going to buy the individual companies, you then had to go and stock pick amongst those which, where, what. So that the speed to market is one aspect. The other one is the efficiency and the cost efficiency with which it is done. Because if you are buying 500 companies, you've got to pay transaction costs and settlement charges 500 times. You buy one ETF that gives you the 500 shares, it's 1 times those transaction costs. And that's why in times like this, when people want to move quickly, sector rotation, asset rotation, geographic rotation, they use ETFs to do that because it gives them that instant cost efficiency.
So we've seen a spike in demand for the S&P 500, which has driven up the value of shares on the Dow. We've seen the Dow reaching, S&P wouldn't drive the Dow, but markets in the US are up, and the Dow did hit a record level just after Donald Trump was announced as the incoming president. In South Africa, though, we've been affected completely differently because we have seen some quite substantial currency weakness, coming back a little bit on Tuesday with a bit of a recovery bounce in the rand. But that currency volatility is what's undermining our market right now.
Yes, and interestingly enough, of course, because of the strength in the dollar, because so much money is now flowing back into the US market, you've seen the rand, along with all the other emerging market currencies, also being very weak. And normally we would expect that to be positive for our market because we've got such a strong rand hedge flavour in our market.
It was good for BHP Billiton, it was good for Anglos, and
it was a little bit good.
For a moment last week, it was great for gold shares until the gold price then plummeted all the way to 1,250.
And what you are seeing is that this is really a currency which is a result of capital flows rather than capital flows coming on the back of currency movements. So normally normally when we see emerging market currencies weaken, it is because of a risk-off trade, fear, problems in the world. This is not the case this time around. The money flowing into the US is not going there because they are afraid and they're looking for a safe haven. They're going there because they believe they're going to find good growth and good performance there. And that's a very different premise for what we had in the past.
Neil Ferguson at the Discovery Leadership Summit this week was talking all about the fact that populism has got classic stages. And there's going to be this boom, there's going to be this belief, and a year or two down the line, many Trump voters look at the situation that they're in. They're probably not that much better off at work. Their jobs aren't that much more secure. Their investments aren't worth that much more. This is a short-term sticking plaster on a wound of a failing system in the United States, perhaps.
Yeah. I think it's fair comment, and it's certainly possible, but that was if you were only to look at the US in isolation. The US is not nearly the superpower and the world power that it used to be 20 years ago. We are, over the next 3 years, going to move increasingly into a world where China becomes, if not the biggest economy, knocking on the door of that US position. We've got India coming to the party as well. Russia is going to be a very interesting player in all of this. So you've got to look at the rest of the world also and say, maybe the story doesn't quite pan out in the US the way that Donald Trump would have hoped it does. But what about the rest of the world? We've got this massive growing demographic, and in particular global consumer in the developing market, which is creating a wave of demand within the global economy, which I don't think we're currently accounting for. We've come out of 10, 15, 20 years of global growth being led by trade. That's not going to be there. So post-globalization, you've got that contraction in terms of global trade, and the thinking is that's going to be bad for global growth. But at the same time, you now have consumption spending rising in your developing market, which is the growing component of the market, which could very well offset what we are losing out in terms of global trade.
Which class of ETFs should we be looking at if we believe that Donald Trump is good for the world economy, he's good for growth, and he's good for rising valuations in global stock markets?
So I certainly would be a buyer of US equities at the moment, despite the fact that there's the appearance that it is close to all-time highs. I think the potential benefit of his policies, and especially on the tax side also, can boost S&P 500 earnings to a point where it's no longer in this bubbly overvalued territory where we've seen it. I'm certainly also a buyer of Chinese equities. There we've got a structural demand for those share markets that goes way beyond the Chinese economy. So those are two key areas for me where, if it's for a long-term bet, that's certainly where I would be invested.
Do you buy for the entire Trump presidency and beyond? And hold, because there is a school of thought that says Trump gets the US into so much more debt, inflation does spike, they do have to start raising interest rates, and the whole bank shoot comes to a calamitous end within 3 years.
I certainly think we're going to see increasing inflation. I certainly think we're going to see an increase in interest rates. I'm not convinced that that is necessarily bad, because it's the reasons why those things come about, which is now a very different reason that we had in the previous years. So I think there's still a lot of uncertainty, a lot of speculation and conjecture. I certainly would not be rushing into making major investment decisions. But ultimately, you've really just got to ask yourself, has your investment goals, your objectives changed from prior Trump to post-Trump? And if that hasn't changed, then the amount of change that you need to do in terms of your investment strategy is a lot less than what all the noise in the market might want you to think you should be doing.
Nerina, thank you very much indeed.
Pleasure.
Nerina Visser is ETF strategist at ETFSA. Thank you very much for watching. More Trump trading madness and Trump trading tribulation next time on the Moneymakers, all the teas this evening as we look at more ETF buying opportunities, selling opportunities for some, no doubt, in the future. For now, though, good ETF dreaming. I didn't write that, honestly. Good night.